call the meeting to order. Go ahead with the roll call.
All right. Mr. Landon Moore.
Present.
Mr. David Holly.
Here.
Mr. Mark Gardner.
Here.
Ms. Karen Savage. Mr. Danny Covey.
Here.
Mr. Joel Hawkins.
Here.
And Stephanie Elliott Williams. And Stephanie did contact me to say that she would be about 45 minutes late, so we'll hold her in advance. So we have a quorum.
Thanks.
Eddie, Stephanie and I were on the team together, and she said she's not on this board. She's on a different board. So
Okay, I'll follow up.
She wanted me to make sure you knew that.
Okay, will do.
Okay. With that, we have two sets of meeting minutes to approve, one from March 10th and the other from May 12th. Do we have any comments or questions about the minutes? Either set of minutes.
I'd like to move that they're approved as written.
Second. All in favor of approving the minutes?
Aye.
Approved. All right.
Can I interject? I wanted to, for the purpose of those people who are watching this meeting, Mr. James Whitney of Greystone is on the telephone here, and he'll be making comments later along with Mr. Brian Birnbaum of Greystone.
Okay. The next item is the Opeb Trust.
Okay, in your package, there's a lot of material, and I can just comment on a few highlights of that material regarding OPEB. As you know, we keep our retiree health care money invested with the Virginia Municipal League, Virginia Association of Counties Pooled Trust, which is managed centrally by VML VACO. There are two reports here. The one for fiscal year 22 is in here, and it shows on page 2 of that report a July 1st, 2021 cost value of $4,987,206 and a cost value as of June 30, 2022 of $5,481,449.60. In other words, the city had put another $500,000 in that account. The market value July 1st, 2021 was $6,683,737 versus the market value today of $6,509,174.87. So a decline of roughly $100,000, despite the fact that the city had put in $500,000. So it's reflecting the market. The other report in here is for just the month of June. And I will just highlight that for the month of June, $341,000 was lost on our portfolio there. And the other thing I wanted to highlight in this is that there is a summary of the asset allocation for Portfolio 1, which is what the City of Portsmouth is in, and it just shows that the long-term estimated value in growth is over 7.5%. So we've had a rough year, and last year we had a great year. So just wanted to highlight those things. In addition, there is a annual meeting coming up on September 23rd. For those of you who would like to come, let me know, to go and let me know, and I will sign you up. It will be in Richmond at the Richmond Marriott Short Pump. And from about, the meeting starts at 10 o'clock, and there will be a luncheon. So that is, I know that you all have been interested sometimes to attend, so just let me
Does
know.
anyone want to volunteer to attend? I don't recall if they had in-person meetings the last couple of years. I went,
Last year they did.
I want to say I went in 2019 before the pandemic.
Yes.
Anyone want to?
Last year, was it in person? Because I was on one of the Zoom calls or
Yeah,
team calls.
I don't know if it was last year or the year before, but yeah, they did have some of them on Zoom. But this one is a live meeting.
No volunteers?
I'll let you know, Patty.
Okay, I'd love for you to go.
Well, if anyone would like to attend, I guess let Patty know. I may try to attend if no one else.
Okay. So no, and if I am not available, because I will be not available much during the month of September, so I'll try to make a decision this month, or Flora or Mimi can make sure you get signed up. And in your material, you can actually sign yourself up if you prefer.
Patty, is the city intending to contribute another $500,000 to that fund in the next fiscal year?
Yes, it is. Yeah, it is budgeted, and it's been pretty good about it, keeping up with it.
Thank you.
Yes, sir.
It's my intent as 1/7 of the council to always try and make persuade my constituents to make these deposits on time, every time. I will always bring it to their attention, and I will not be happy with them not contributing.
It's good to hear.
All right. Next on the agenda would be Greystone's review of the investment performance.
Great.
Mr. Birnbaum.
Thanks, Landon. Good morning, everybody. It's great to be with you here today. Jim is on the phone. He's going to review his, standard charts related to Outlook. Let me just kind of preface it by saying, and then I'm going to come back and talk about portfolio results. June was a tough quarter across all capital markets, whether we're talking about bonds, stocks, large cap, small cap, U.S., non-U.S. Everything was bad in June. But for how bad June was, July and the early part of August are looking quite different. Now, we think it's temporary that Jim's going to talk about, but since the end of the second quarter, things look dramatically different than they did at the end of June. So I'm going to talk about the June quarter, but I'm also going to give you an update about what's going on here the first part of the third quarter. But Jim, do you want to take over, and then I'll pick it up when you're done?
Sure, Ryan. Good morning, everybody.
Good morning.
Sorry I can't be there in person with you, but I certainly will be for the next meeting. Brian, we're going to get started on slide 3, small business.
It's the first page of the charts. Okay, yep, we're there, Jim.
Okay, can everybody hear me okay?
Yep.
So I'm going to walk you through a couple slides that we want to highlight, talk about how we think the economy is performing, and where we might be going from here. So the first slide is small business confidence. This goes back to 1975, so it's not like a 2-year chart. As you can see, the outlook for general business conditions has never, and I repeat, never been worse, even than the great financial crisis. It's literally off the page, and the main result of what I would say is a very difficult operating environment for companies. Inflation is a problem, labor, trying to find people, geopolitical concerns. So with this reading, it's pretty hard to get excited about the economy. The next slide.
What do does the scale mean? The numbers.
On the right-hand side.
Anything below 0 is sort of bad. Anything above 0 is good.
Yeah, the zero is the baseline, and confidence is rising or falling above or below 0.
It's a subjective assessment of how small businesses and owners are feeling about the prospects of their business.
Is this
Future or now?
Well, it's sort of a here and now kind of thing, but it's as they think about their businesses and how they're positioned, given what we're currently going through. So there is some forecast aspect to it, but it's based on sort of the here and now.
Okay.
How does it correlate with the VIX?
Well, so I don't know that we looked at this. I can tell you that the VIX is pretty darn low right now. So even though small business confidence, to Jim's point, has fallen off the page, the VIX is pretty low. So I'm not so sure that you're going to see a terribly tight relationship between those two measures. Okay, Jim.
Okay, next slide talks about consumer confidence. At the top, we've got the University of Michigan consumer confidence. Then at the bottom, we've got the University of Michigan's consumer confidence. It's basically for large household durable purchase. And here you can see this too is extremely weak. In fact, again, we've never seen consumer confidence this low outside of a recession. Inflation, as you know, is extremely high, and that's what we're seeing at the bottom part of the panel. It's really weighing on consumer confidence. So it'd be really great to get inflation under control. We think the Fed has made a lot of positive steps in that regard. It's painful medicine, but it would be good news the sooner it's administered, because the faster we can get out of the pain of inflation on the consumer and business. The next slide is a look at inventory, and we're actually starting to see increases, significant increases across the board. We had wholesale inventories which were increasing last year, and now that's spilling over into retail inventories. The bottom panel, you could see total inventories are well above trend. So this is another part of the solution for inflation. We're going to have probably too many goods at this point, chasing too few consumers. And we're starting to see this in some of the major retailers' earnings announcements. If you are aware, last quarter, Walmart, the nation's largest retailer, guided down excess inventory. Target did the same thing, guided earnings down, excess inventory. And it's kind of hard to imagine. Just not that long ago, it seemed like there was a complete shortage of everything.
Is this adjusted for inflation? Is there more stuff, or is it just worth more because prices went up?
I believe this slide is.
Excuse me.
So we know that.
Question.
We have a question from
Jim, we have a
Mr.
question.
Jim, how is the inflation impacting prices and the overflow of goods affecting prices? With the overflow of goods on hand, does that bring the prices down any?
Yes, that's a great question, and I think we've heard many times blaming inflation on the lack of supply here, but we would argue that we have a logistical problem, and as opposed to a supply problem if you look at these charts. So we just couldn't get the goods where they were needed. Our expectation is that this is going to be a partial solution to your question about inflation with these excess inventories. I mean, when we're already seeing Walmart, Target in my earlier comments, slash prices to clear out inventory to make room for back to school. Ultimately, that's going to benefit the consumer.
But not corporate profits.
That's not corporate.
Excuse me, this is Patty. Has the inflation number been released
Yes, yesterday.
yesterday?
Yeah.
Down yesterday, didn't it?
8.5,
Is that
down from 9.1.
Okay, so at least going in the right direction. Still not too good.
That's right. Still 40-year highs.
Yeah.
Yeah, yeah.
While that inflation number was indeed a positive surprise, it was primarily driven by lower energy costs.
Yeah.
The core inflation was still quite substantial.
Yeah.
But directionally, very good.
Yeah, and can't afford to eat practically.
Ramen's still cheap.
So this next slide, the bond market moves ahead of the Fed, and it does the Fed's tightening. This chart shows 10-year yields. Is very related to what we call the terminal rate, so that the bond market has a futures market, and it basically predicts how far the 10-year Fed is going to be able to get Fed funds in this cycle. So it's about a month ago it got to 4%, meaning the bond market was thinking that the Fed funds might have to go as high as 4%. But you can see through those red circles that historically speaking, this terminal rate tends to overshoot how far the Fed is going to have to be able to go. And the 10-year yields follow that. That's what those red circles are. So the 10-year never got that high at 4%. And it's our view that that 10-year yield has probably already peaked at around 3.5%. Pretty tight correlation with the futures market. We're already, in this next slide, we're already starting to see a cooling effect from the Fed tightening with mortgage rates moving up. Mortgage applications plummeted, really starting in line with the 30-year mortgage rate last year. The blue line here is mortgage rates. It's inverted, meaning the scales turned upside down. So when the blue line's going down, that means mortgage rates are actually going up. They were around 5.25% for the 30-year mortgage, and you could see how mortgage applications track that very closely. And mortgage applications are a leading indicator of housing activity. So we all know that the housing market needed to cool off. It seemed like it was a bit of a bubble, but the mortgage application index indicates that the Fed's work is really starting to impact that market. This next slide just tells you a little bit about the external dynamics of the U.S. equity market. And here we're looking at the cap-weighted defensive sector. So we're looking at state healthcare, utilities, and what we're looking at here is that almost 60% of the most high-priced momentum stocks in the market were defensive. So effectively, investors had been buying the most defensive parts of the stock market, bidding those prices up, and effectively pricing in a recession.
Let's talk about that just a second. There are some that believe we are currently in a recession, and there are others that think it's going to be a soft recession starting probably first of next year. What is the thought of Greystone?
Our view is that we're going to have an economic slowdown. We actually don't get too distracted by the narrative of a contraction in GDP of 2 quarters. The Fed, in our view, will engineer a soft landing. So it's going to be slower growth. It could be 2 or 3 quarters. Could be quarters. A couple of those quarters could be negative.
Negative growth is slower.
Yeah.
For what it's worth, we went back to 1947 and looked at situations where we had 2 consecutive negative quarters of GDP growth, and every time that happened, there was an official recession declared 10 times. We've had 2 consecutive quarters of negative GDP growth. There's a big debate going on about whether that's a technical recession or not. There's an organization out there called the National Bureau of Economic Research, who is the arbiter of whether we have an official recession or not. And in some sense, whether they declare a recession or not is kind of irrelevant. In fact, a couple of weeks ago, there's a noted economist, his name's Paul Krugman. He was asked, are we in a technical recession, and does it matter? And his answer to both of those questions was no. When you're in an economy that's slowing, as Jim talked about, does it make a difference whether it's a technical recession or not? That's going to impact corporate profits. That's going to impact stock prices. I think last time we were together, you brought it up. We had 1 quarter of negative GDP growth landed, and you said, what if we're already in a recession? And here we are, and that's the exact thing we're debating.
Just a readjustment period anyway.
I'm sorry?
Just a readjustment period anyway.
That's right. Even the deep recessions fade. And I don't think, whether we're in an economic slowdown or a technical recession, I don't think anybody thinks the slowdown or the potential recession is going to be deep or severe.
I agree.
It might last a few quarters, it might be negative growth, it might be positive growth, but the excesses will get worked out of the system relatively quickly, and then we will get on our path back to economic growth.
What would be the impact of negative 2 quarters in a row on the system?
Well, we've had 2 negative quarters of GDP growth. First quarter was negative, second quarter was negative. Through June, the stock market in this country was down about 20%.
I know.
We've got about 70% of our assets invested in stocks. Yep. Okay, Jim? Sorry.
Okay. Keep in mind that recessions don't occur when unemployment is at 3.5%.
Yeah.
Right.
Which is the lowest level we've had since 1969. So Powell is fighting to regain credibility, and the only path to get there is to continue to tighten. Usually the Fed tightening cycle doesn't end until the Fed funds rate is greater than the core inflation. So with core inflation likely to fall below 4% over the next, unlikely to fall below 4% in the next 6 months, the Fed has a ways to go, especially with the labor market.
There's a disconnect between your consumer confidence slides and what's actually happening. People are actually doing pretty well, but they don't say that they're doing well.
Yeah.
If they have a job.
Which
that's,
And
we know that that's changing. A lot of these big companies are letting people go or downsizing.
They are. The plans at the corporate level for hiring have absolutely started to slow. It's not working its way through the employment data yet. There's still 1.8 jobs available for each worker. And that, this tight labor market is why we think it's going to be, why the Fed is going to continue to increase short-term rates, because they need to get a handle on wage growth, which is a big part of inflationary pressures. The other thing, Jim, before you go on to the next slide, I think it's worth pointing out. Bear markets don't begin typically with recessions, because the stock market is a forecaster of what's going on in the underlying economy. And the stock market figures out what the economy is going to look like 6, 9, 12 months in the future. So we've had 2 negative quarters of GDP growth. We've had significant declines in equity markets leading up to that. You would expect that, because that's the typical relationship. And if the economy continues to slow, one would expect, stock prices to decline, but not in lockstep, and not the stock market is going to bottom and is going to turn before we see the economy starting to grow at acceptable levels again. And that's why this thing is so hard to time. It's just impossible. We'll talk about how we're positioned to take advantage of how we think the future is going to unfold. But you've all heard the adage, don't try to time the market, and that's absolutely true. Okay, sorry, Jim, go ahead.
Yep, no problem. Just to close the unemployment rate, it last Friday 3.5%, and it added a shocking 528,000 jobs, according to the Bureau of Labor and Statistics. And that labor growth was widespread in July. So we may have had two quarters of negative. Those numbers tend to get revised repeatedly. Maybe they won't. But to us, it doesn't feel like the Fed is really close to its end of its tightening campaign. That's a lot of consumer buying that picked up in just 1 month. So we're looking at, I think, which will be our last slide here, Purchasing Managers Index. It's something our chief equity strategist spends quite a bit of time tracking. And it's basically a manufacturing index, and we're overlaying that with the S&P 500 year-over-year change. And what we see here is that it does a pretty good job of telling you where the S&P should be on a year-over-year basis. And it's actually fairly accurate in terms of where the S&P should be trading today. And really what this chart tells you is that if we do slide into a recession, the Purchasing Managers Index, in our view, could slide to the low to mid 40s. That would take us to about 3,000 on the S&P. I think there's a chance of that happening, a relatively small chance, but a chance. And where the equity markets are trading today, PMI of 50 for July is about equivalent of 3,700 on the S&P, and we're at 4,200 today. So I'll just close by saying most of the market action in the first half came from changes in real rates and valuation multiples, where the recent moves that Brian mentioned seem to be premised on falling inflation expectations and what was a technically oversold conditions, and certainly some weak positions. Unfortunately, we've not seen earnings reset. This is probably the biggest issue for us. Analysts seem reluctant to lower their earnings targets. The second quarter was quite good. Target was about around a little over 5%. They came in nearly 10%. Big driver of that, of course, was the energy sector. But we do think the second half of this year and early 2023 is where corporate earnings need to be revised. They're vulnerable now, in our view, due to rising costs of input and labor, and then fading pricing power won't help corporate profits. Rising inventories, so it's seems like it's just a rally in a bear market for us at this time.
By the way, it's, I just looked, we had a PPI number come out this morning. To Jim's last slide here, it was negative because the price of oil has come down so much. But when you strip out food and energy costs, PPI rose less than expected. So another small piece of data that is encouraging that inflation is beginning to come down.
So Brian, maybe I'll turn it back
Yeah,
to you.
perfect. Thanks, Jim. I'm going to go circle back to slide 2. I'm just going to make some comments on this slide, then we'll get into the portfolio. And I guess I just sort of preface my remarks by saying we've got some sort of bad news and good news to talk about. The bad news being the second quarter in terms of how the capital markets look, the good news being how things look the early part in the third quarter here. As I said at the outset, for as bad as the second quarter was across all capital markets, today things look markedly different. So in the, you could see the returns there in the 3 months period. So second quarter results, down double digits for global equity markets. Bond market was down about 5%. For the year-to-date period, that put us down, call it, but high teens, low 20s for global equity markets, and down 10% for the fixed income market. And a lot of that return being driven by what we experienced in the second quarter of this year. 10-year Treasury in the second quarter went from 237 to almost 350. That's a massive move. That resulted in that bond market year-to-date return of down 10%. The worst bond market start to the year we've had since 1788. And I throw that year out there and people say, come on, that can't be right. And it is, because it was the year before George Washington was president. Obviously, we didn't have treasury bonds back then, but the country issued bonds to finance the American Revolution. Somebody went back to the 1700s to say, okay, what would these bonds have done? That was the only time that we had a worse start to the year than we're experiencing right now. Because of today, by the way, so we peaked, Jim talked about it, about 350 on the 10-year. Today we're between 260 and 270. So we've had interest rates come in because the market is now expecting that the Fed's got a handle of inflation. Doesn't mean they're going to stop increasing interest rates. But what it does means is that the market perceives the Fed will get control of it. We're seeing small evidence the last couple of days. CPI coming down from 9.1 to 8.5. PPI I just referenced earlier, when you include food and energy, it was negative, which was great. Even when you pull it out, it went up less than expected. That's all very good news for interest rates. It's very good news for equities. GDP in the first quarter was down 1.6, and the second quarter was down 1.2. We talked about whether that's a technical recession or not. Clearly, the economy is slowing. Oil prices in the second quarter peaked at 128. Today, we're in the mid-90s. That's why you're seeing inflation come down. And the market expects inflation to come down. In the second quarter, for the next 5 years in the future, the market had expected inflation to be about 3.5%. Today, that expectation is closer to 2.5%. So all of that is good news, and that's why July and August look so much better than the June quarter did. If I come back to the June quarter, we were down 16% on the S&P 500 index. Every single sector of the stock market was negative, and 7 of the 11 sectors were down more than 10%. Again, it's starting to paint a picture of how rough the second quarter was, but let me just kind of give you some numbers for the first part of the third quarter. While we were down 16 in the second quarter on the S&P, we're up about 11.5% since the end of the second quarter. Small cap stocks are up over 15% in the third quarter. Non-US markets didn't fare as well. They were still positive. Non-US markets were up about 5 in the early part of the third quarter. Emerging markets were slightly positive, call it 0.5% or so, and the bond market was up over 1.5%. So again, third quarter looking a lot better. We still have a long way to go. Jim talked about the outlook. We're a little bit concerned about the remainder of the year, particularly as it relates to corporate profits, as these higher inflation numbers and tight labor markets start working its way through corporate earnings later this year. And we think that, in all likelihood, could be the catalyst for some further weakness in equities. We're going to go to the lows of which we experienced? Maybe. But we think the market's rallied significantly. We'll talk about how we're positioned. We think it's gotten a little bit ahead of itself. Okay? But we've participated, which is great. Any questions about that? Okay, let's talk about our portfolio. Gonna go to, we gotta do a better job of page numbers on these things. So there's a page here, I don't know, a quarter of the way through the book, time-weighted performance summary. If you look on the bottom right-hand side of that page, it says page 6 of 11, but it's not obviously page 6 in the deck. But if you can move.
It's in the performance, this section,
There you
right?
go. Yes. If you find City of Portsmouth portfolio analysis,
Yeah.
go forward a couple of slides. You've got it, Landon. Yeah. Okay. So here's the return of our portfolio on the first column there, the quarter-to-date period. For the second quarter, year-to-date, last 3 years, and since the early part of 2016. We're down a little more than 12% in the second quarter. It's a little bit better than the benchmark. The benchmark was down 12.2, so we're about 15 basis points ahead of our benchmark. We would have obviously much rather have done better than down 12, but anytime you can do better than the benchmark, that's not a bad outcome. Reality is all capital markets were down. We participated in that down just as we were participating in the up in the third quarter. Here, I'll give you an update where we stand in the third quarter. But disappointing on an absolute basis, but on a relative basis, the results were, at least a little bit ahead of the benchmark.
Given your positioning,
Yes.
would you have expected to do better on a relative basis the last quarter? I was just looking at the minutes from the prior meeting, and you were underweight. You underweighted equities, which was a good thing.
We did.
But it seems like it didn't really even help that much.
The equities we had were bad, and so that's why we didn't do better. And the equities we had were kind of growth-oriented technology stocks. Value stocks outperformed in the second quarter. We were somewhat underweight that. Now, in a slowing economy, and arguably a recession, even though that's not our base case, but let's just, in a slowing economy, growth stocks tend to do better because investors are looking for any type of earnings growth or revenue growth that they can find in a slowing economy. What we have seen since the end of the second quarter is those growth stocks start to outperform dramatically. Before we got started, I talked about the NASDAQ being up 20% off of the lows. That has been the best place to be. So we are, although we didn't do as well as we would have liked to in the down market, we're actually doing better in the up market because of the way we're positioned, even though we're underweight equities.
So July has been a good month. Was a good month.
July was a good month. The early part of August is a good month. So in July, we were up a little more than 5.5%. That was about 20 or 30 basis points better than the benchmark. And in the first week of August, we're up another 1.5%. So smushing them, and this doesn't include the alternatives bucket, which is about 8% of our portfolio. That's not, we don't get the data on that until down the road. So this is just the public market. So you add the two together, the early part of the third quarter, we're up probably 6.5% to 7%, even though we're underweight stocks. Yes?
So you're saying the first quarter we dropped 16%. That's the darkness. And with the daylight that has surfaced, where are we at this point?
So the second quarter, the S&P 500 was down 16%, not us. In the second quarter, we were down 12. So yes, that's the darkness.
Okay.
The upside has been, we're up about 6.5% or 7% since then.
So how
So
does
we
that-
recovered about half of what we lost in the second
Okay.
quarter.
Okay.
In a few minutes, I don't know if Brian or if Tom will be going over the comparison of our assets versus our projected liabilities and kind of see where we stand, which will then determine what's the city's contribution with actuarial work.
So,
Because it's based on the June numbers.
Yeah.
Well, yeah.
so we're still down about 16 million. The
I don't-
darkness was about 33, and if we got a half, we're still down about 16.
So we are, on a year-to-date basis, we're probably down 11%
Okay.
Calendar year.
calendar year.
Okay.
If you go all the way to the right-hand side of this table, performance since the early part of 2016, which is when we started working with the city, we're up about 6.7%, right in line with the benchmark. That number used to be significantly higher than the benchmark, as this board knows. It's the recent returns that have dragged that down. But 6.7% translates into about $67.5 million from the investment returns that were generated, that we now have in the trust fund. On the next slide, and this gets a little bit to some of the discussion that we had about how we're positioned and returns relative to benchmarks. We're at about 65% in equities. Our target's 70. So even though we're about 5 percentage points underweight stocks in a rising market, we're still outperforming. It's because of the stocks we own. The stocks we own were the worst ones to own the first half of the year, the best ones to own this so far in this part of the year. As Jim talked about, we're concerned about corporate profits later in the year and the impact that that's going to have on potentially bringing equity markets lower. So we really like the way we're positioned for how we think the future is going to unfold. Underweight stocks should help us if we start to roll over here, reflective of a slowing economy, tight labor markets, and the impact that has on corporate profits. I want to talk about, on slide 3, a little bit about what we've done during the course of the year. There's on the top part of this page, there's a table in there that shows underweight, neutral, overweight to different areas of the capital markets. So how is our portfolio positioned relative to how the overall market looks? You can see we're underweight equities, as we talked about, and in particular, we're underweight large cap stocks, so the S&P 500. And the reason we're underweight those stocks is they've held up the best. Last year, they performed the best. Last year, the S&P 500 was up 28 or 29%. Got way ahead of itself, so we wanted to pull back some of that exposure. In fact, in the first quarter, we reduced our large cap exposure. We reduced it further in the second quarter of this year. So we used some of the strength in equity markets to pull back a little bit more of exposure given how we think the rest of the year is going to unfold. We've increased our small cap allocation in the first quarter. That was relatively good positioning, particularly in the early part of the third quarter. I mentioned Russell 2000 stocks are up 15, the S&P's up 11. So that overweight to small cap stocks relative to large cap stocks helping us. In the second quarter, we reduced our allocation to Europe. We think Europe is mired in, going to be mired in a relatively deep recession, given everything that's going on between Ukraine and Russia. That is going to have a substantially larger impact on their economy than our own. And so therefore, in light of that, we want to underweight that region of the world. And in fact, we've done that. We pulled back our European exposure during the second quarter.
What's the anticipated impact on the investments in Europe? What's
Europe is dramatically underperforming the United States right now, and we would expect that to continue given what's going on over there and the issues that we don't necessarily have over here. So in light of that, we have reduced our exposure to Europe and concentrated it on other regions of the world.
and the exposure that we are investing? What's the guesstimate of the damage to that investment?
So Europe is down. A second.
A bunch.
Actually, Europe's down through the first half of this year 20.3%. It was down in lockstep with the U.S. equity market. So I don't think we've seen the impact relative to the U.S. yet. In the early part of the third quarter, when the S&P was up 11, non-U.S. markets, which Europe is a big part of, I don't have Europe specifically, but it was up only 4 or 5. So it was still positive,
Right.
which was good to see, but certainly not as strong as the returns we're experiencing here in the U.S.
So they'll do about 40% of loss that to our 60. If we do a 60, they're going to do a 40% loss.
It's hard to pinpoint exactly because there's all sorts of things that impact the returns that generated from Europe. It's not only what's going on in those equity markets, but it's also dependent on what happens with the U.S. dollar. The dollar's been incredibly strong because the Fed is increasing interest rates. Typically, when the Fed increases interest rates, the dollar rallies, and non-U.S. markets don't do as well. In fact, we've absolutely seen that. And then when interest rates go low, the dollar tends to go down, and that's when those non-U.S. markets, in theory, are supposed to do better. We're still in a Fed tightening cycle. There's no question about it. Inflation is not under control, despite the fact that we've had some positive signs. The Fed is going to continue to increase short-term rates. In all likelihood, the dollar will continue to be strong, which will be a challenge for equities in Europe in particular. The last thing I'll mention is during the second quarter, we increased the duration of our bond portfolio. And again, that was a good thing to do. As the 10-year was getting close to 3.5%, we added probably about a half a year's worth of duration. Because we thought the big move, as I mentioned earlier, the big move had been made in interest rates. We hadn't seen this kind of moves in a couple of centuries. And we felt that it was a pretty good bet that interest rates were starting to peak. And in fact, it appears as though they have. 3.5% down to, call it 270 on the 10-year. So all those things, the way the activities we've taken are working out pretty well, and are working, we expect to work based on how we think the rest of this year is going to play out. A lot of time to go, remains to be seen, but those changes to portfolio composition we made are working to this point. Let me go to slide 6, which is attribution. The way to think about this chart, this is just looking at the second quarter. We're gonna do a longer term attribution here, hopefully the next time we get together, because it's one thing to talk about what happened in the most current quarter, but quarter's a short period of time. It's much more relevant to look at a longer term history to see if the decisions we made are working or not. But this is the second quarter. So the way to look at this is, if we did nothing but were each and every day on our 70% stock targets, 22% bond targets, 8% alternative investment target, and we earned nothing but those broad index returns representative of those three markets, our second quarter return would have been minus 12.22%. As a practical matter, it's impossible to be on those target allocations each and every day, and it's not practical. So we could overweight some market, we can underweight a market relative to those broad targets, and that has some impact. That's what that broad asset allocation effect is. The fact that we're not always on our investment policy targets each and every day. Talked about we're underweight stocks. And we want to be able to measure that impact. That's what's picked up under broad allocation effect. The fact that the number's positive means that the decisions that we made to over or underweight certain asset classes, hold a little bit of cash, frictional cash, that added about 40 basis points to returns. It's a good thing. Now that was offset by what's called the sub-allocation effect. So the sub-allocation effect, the way to think about that is within asset classes, stocks, and within bonds, does our portfolio look like the broad market? I mentioned earlier we were overweight small cap stocks relative to large cap stocks in the second quarter. So that means our portfolio doesn't look exactly like the US equity market. Talked about we were overweight non-US stocks in emerging markets. Those decisions detracted 37 basis points from returns. So we were up 40, down 40, roughly, on those two decisions. So they're pretty much a wash. The selection effect is, did our managers pick good stocks or bonds? And at least in the second quarter, they did. Longer term history is quite good. The last 12 months or so has been not great for our active managers, which is a big reason why our return is in line with the benchmark over a longer period of time now. But in the second quarter, our managers did pretty okay. They added about 27 basis points of return. You add that all up, you get to a portfolio's return of 1192. Now, down 1192. The reason why this return is different than the one we already talked about is because we can only run attribution, unfortunately, on a gross of fee basis. So the difference between the 1192 and the 1207 that I referenced earlier is fees. Okay, so again, short period of time. We're going to do this over a longer period of time. You're going to see bigger impacts. Okay. Any questions on that? One more slide, if I can ask you to turn to page 8 of 18. Sorry, we'll do a better job of numbering these things. It's behind the appendix, and it's page 8 of 18. So here are the individual investments that we have. We use a combination of active and passive management, as this board knows. The active managers, and I'll just focus on the year-to-date period here. The active managers we have in place, this has been a struggle for our active managers the last 6 to 12 months. In fact, over the year-to-date period, we only had 4 4 managers of our 12 active managers that outperformed. If we looked at it last year or the year before, you'd see the exact opposite. And the reason why it's been so difficult for our managers to outperform, and you don't need to turn to this page in the third quarter, but I'll just, in the second quarter, I'll just kind of reference it and hold it up. It's because of this slide that was the second slide in the book. It looks at the returns of different factors over time. And the year-to-date period, there's this factor called quality. And it was the worst place to be in the equity markets. Now, what does quality mean? Quality is investing in companies that have strong earnings growth and revenue growth, well-known brands in the marketplace, low levels of debt on the balance sheet. These are good companies that you want to hold for the long term. Companies like Microsoft and Apple and Procter & Gamble and Johnson & Johnson. Companies we all know and whose products we use arguably on a day-to-day basis. Those were the worst companies to own. They were the best companies to own last year. Over a long period of time, these are the companies you want to own because these are the good companies. But you can get into very short and discrete periods of time where those kinds of companies underperform the market and sometimes underperform the market dramatically. That's the period we're in. Now, it just so happens that those companies are doing among the best in the early part of the third quarter, which is why on the good news is that we're participating. We've got the right stocks, even though we're underweight stocks. That's why we're doing so well in the third quarter. The other thing I want to point out is, we've had some discussion around one of our emerging market managers at this board meeting. And I want to point this out because the numbers have been shockingly bad. And that's the first one on page 8. Year to date, this is Artisan Developing World. This is an emerging market, an active emerging market manager we have in our portfolio. We've had for a long period of time. Year to date, that portfolio is down almost 38% through June. It has underperformed the down 17% return of its benchmark. Now, what the heck is going on there? They hold about 40% of their portfolio in stocks that trade on the U.S. stock exchange, and in particular, they're platform kinds of companies. They're a big holder of the parent company of Snapchat. It has been a disaster of a stock.
Who owns Snapchat now?
It's Snap is the name of the company, the publicly traded company. But they invest in these platform companies. What does platform mean? It's like, Facebook or Snap or it's these companies, these social media type companies that have access and exposure to billions and billions of people. And the trick for those companies is to monetize their user base. And in some cases, some companies have done a better job of that than others. This single investment has been there's no way of getting around it. It's been bad, right?
I was under the impression that y'all got rid of that particular fund.
We've reduced exposure dramatically.
Okay, maybe that's what it was.
Yeah. The interesting thing about this portfolio, though, so it's been at the bottom of the universe of emerging market managers this year. You look over the last 3 years, the last 3 months through yesterday, which would include a good chunk of the second quarter, the number one returning emerging market portfolio. It's up 15% over the last 3 months. Over the 3-year period, it's the 5th best returning emerging market portfolio. We've had it that entire time. It's just this recent period where I would say over the last 12 months where it's been a struggle. but over the longer period, it's done well.
Would you say if you did an analysis on the dollars, you would have sort of won because you had more invested in the good time than you did in the bad time?
I'll tell you, and this is before, Lanny, I think this was before you were even on the board. So when we had a non-discretionary relationship, we had a double weight to emerging markets. And most of that exposure was with this manager. We were up 80 and 90% in some years. We've dramatically reduced that exposure, and we've even reduced it recently. So you're absolutely right. If we were to dollar weight that return, it would look totally different. It's not the way industry standard is to present performance, but you're absolutely right. By the way, we still like this manager, which is why we haven't gotten rid of it.
I'm scratching my head why they would have SNAP at all. Being in emerging markets, they just say people all over the world use social media, even in emerging markets, so we can categorize it as such, even though it's traded in the U.S.?
That's exactly right. I think some of the geographic boundaries and the historical way that we've all thought about exposures and how we allocate capital are arbitrary. We've historically done it by geographic boundary. But the world is interconnected. Every company has exposure to pretty much every country around the globe. And so the way they think about it is they look through to see where the revenues and where the revenue growth is coming from. Is it coming from the U.S. or is it coming from overseas? Case of SNAP, it's not a U.S.-centric growth company anymore. It's much more overseas and emerging market in particular. Same with NVIDIA, a chip company, which is one of their big holdings. So the world is becoming much more globalized, and it's caused, and this is one of the reasons why I like them, they think about the world a bit differently than everybody else. And that means their portfolio looks a bit different than everybody else. And that's why we like them, and that's why we put them together with more traditional. Sorry.
Did we get involved with defense and health care from a futures perspective?
We definitely have exposure to those sectors of the economy, absolutely. I don't know what our exact exposure is, but yes, we do.
Okay. And what I'm saying is from a futures perspective, when the Soviet Union was saber rattling before they made their move, that's a futures perspective. And when we first got a whiff of we're going to have a possible pandemic, at those points, are we making moves from the scope of the flow of normal living like that?
So we do not pick individual stocks. We hire managers that go out and buy the individual stocks. Some of them may or may not be increasing or decreasing exposure to those places. But we absolutely do have exposure to defense. We have exposure to all sectors of the economy. There's 11 sectors in the S&P 500 index. We have exposure to 11 sectors. We are broadly diversified. We are not overly concentrated in a particular area. We take certain risks, and the managers are taking certain risks to outperform the market. Sometimes it works, sometimes it doesn't. Like the first half of this year, over a longer period of time, we can show you that it has worked. But the decisions on portfolio structure are theirs. Lastly, just so that one emerging market portfolio, I told you 3-year return, they're the 5th highest, or they're in the 5th percentile. 5-year period, they're in the 1st. So again, we've part of our job is to position the portfolio in terms of broad asset mix to capitalize on opportunities or risks in the future that we see. It talked about, in fact, we're underweight stocks. We think markets will roll over, particularly as we get into third quarter earnings season. We can manage the allocation to individual managers. We've been using this portfolio as a source of funds. It's helped us preserve some capital. And those are the decisions we make. It's been a tough 6 to 12 months. There's no sugarcoating that. But based on how we think the world is going to unfold, we feel very good about how we're positioned. We feel very good about prospects of getting back to the point where we're generating returns in excess of the benchmark. We did it in the second quarter, small amount. We have every expectation that we'll get back to where we were. So with that, I'll stop and see if there's any further questions.
Brian, Artisan is about 3%
Yes.
now.
What did that come down from?
Oh, I want to say we were about, before we had discretion, we were probably pushing 8 or 10% to that. Maybe not quite 10, probably 7 or 8%. So we've cut it more than in half. And again, we want exposure to emerging markets, because that's, from a long-term perspective, that's where a lot of global economic growth is coming from. And that should result in higher stock prices, and the valuations there are a bit cheaper than they are in other regions of the world. So we want exposure to. We have de-risked that exposure by cutting that portfolio down dramatically, but obviously we wish we would have done more. But again, we still feel good about how that portfolio is constructed, and once we get to more kind of stable markets, this portfolio should shine again.
The strategy short term is to kind of hold it around 3%.
Yeah, I would say so. Yeah, unless something dramatically changes. But I think we're down to the point where we're comfortable with the exposure we've got and the risk that this portfolio has on the overall portfolio. Other questions?
One more quick question. Do you trade the ETFs and the ADRs?
So we do have ETFs in the portfolio. In fact, with the changes that we've made in the second quarter and the early part here in the third quarter, we're up to about, call it a third or 35% of our portfolio in ETFs right now. We have a couple of active managers that use ADRs as opposed to ordinary shares. We don't trade it ourselves. Those managers' portfolios are comprised of ADRs.
Oh, okay. Got it.
Does that make sense?
Managers you hire.
Correct. Okay.
Brian, I would just close by saying that we've had conversations, follow up with each of these managers, and at 20% drawdown, broadly speaking, across the equity markets has allowed each of these managers within their respective disciplines, large, small, mid, value, growth, etc., to really concentrate on what they think are their very best names and reposition those portfolios. So our expectation is they own the best names, bigger weightings, and that should all manifest itself hopefully in performance going forward.
Jim, I'm glad you brought that up. That's a good point, because in some sense, these periods that we're going through right now are unavoidable, unless you're going to try to time the market, in which case you're going to be wrong more often than you're right. In our view, it's what you do in these situations that set you up for better returns going forward. And the question in our mind, not only for ourselves in the way we position portfolios, but for the managers that we have in our book as well, what are you doing now that's going to shorten the time it will take for you to recover the value that you've lost? And that's what it's about. It's not trying to avoid these deep losses. Markets go up and down. Markets are volatile. Nobody really could predict all the things that were going to unfold here and the impact that that was going to have. But what we do know is we got here, we know how we got here. What are we doing now? We're using the strength in the equity markets to reduce equity exposure because we think we're going to roll over. And those managers that Jim talked about, they're concentrating their portfolios in their very best ideas. Those two things combined, hopefully, and in our mind will happen because we can show you that we've done very similar things in previous situations, will shorten the time it takes for us to recover.
I'll just sort of add to that, as a pension fund or retirement fund, you have to stay invested. Markets go up more than they go down. We're not here to make timing bets.
Yep.
So, in these periods, and, I'd say the next 12 to 18 months period is, going to be very important for the overall health and performance of this retirement fund. And hopefully you guys are positioning us, in the right way.
Yep. We think we are. Might there be further downside? Sure. But over, a longer period of time, this is the portfolio that we've settled on in terms of, as best we can, reducing the ultimate cost to the city of operating this pension plan by generating good long-term returns, colored with the fact that, we got to consider the risk side of things too. So a 70% equity portfolio is not out of line relative to what other public pension funds are doing. In fact, it's about right in line. So there's comfort in knowing that. Obviously, we're trying to do things that can set us up for success as we look into the next 6 to 12 months.
And I think that the most important thing is to make money in the stock market, and I think that limiting yourself and putting gates around you that limit your access to making this money is kind of counterproductive. As an investor, I'm never comfortable with, I'm going to win some, I'm going to lose some, although that's the nature of it.
Yep.
But I just have a somewhat of a different perspective.
Over a long period of time, we will make money, and we have made money. We've made a lot of money.
It goes back to you own the right companies.
That's right. And we've got the right exposures. There's no avoiding losing money over short periods of time. But I've got, it's just kind of, I know I have this somewhere. I'll give you you'll get the point. My numbers might be a little bit off, and we may have talked about this in the past, but we went back over the last 30 years. And there's 250 trading days on average in any given calendar year where you can make a decision to buy and sell stocks. 250 days a year. Multiplied by 30 years, that comes out to about 7,800 days over that 30-year period that you can buy or sell stocks. You're fully invested each and every day. At $1 at the start, that same dollar at the end was worth about 10.7% per year over that 37-year period. If you missed 1% of the best trading days, your return goes from 10.7 to negative 0.5. You could be right 99% of the time and be wrong 1% of the time, and your return goes from 10.7 to negative. This is why we don't do it. This is why nobody should do it, because nobody can do it right consistently.
100% of the time.
That's right.
No one can do it 100% of the time.
That's correct. Unless you're fully invested, in which case you're not. Your decision is to say, okay, I'm going to be fully invested. And yes, in the interim, it's going to go up and down, but over a long period of time, I'm going to make a lot of money.
We're not looking for 100%. when we made the last bond loan, we were at 78%. We're just looking to maintain or to do better than that,
Yep.
78%. But at the onset of the loan to make the retirement system solvent, we were at 78%, and now we're talking about 70%.
Yeah.
And when we talk about 16% and 8% and so the percentiles,
Yeah.
I transfer that right away to actual dollars.
Yeah.
And I just have a little different perspective, but like you say, I want to make money for the city. I want to make sure that this system remains solvent, because we can't push the city
Agreed.
any further to do what we've done in the past. And that's why I have a very cautious and view and want to possibly stay on top of this as much as we can and make as much
Agreed.
money as we can. But again,
Agreed.
we were at 78%. Yet the axis we talk about now is 70%, which is not bad, but
Yeah. So let me,
I'm looking at 78% or better.
if I could just make a couple of comments on that. Number one, the system is solvent. There's no question
I was going to say that.
about that. Secondly, and I think Andre talked about this when at the city council meeting a month or so ago, when the bonds were issued and the projections he made, there was an expectation that the funded status was going to fall. And so I believe, and we'd have to go back to the video to check this, where we are today is about where we thought we would be, where he thought we would be in terms of funded status. So there is nothing, I would say, unusual about the funded status today that Andre didn't think was going to happen when the bonds were issued.
Yeah.
Lastly, and again, I don't have the numbers in front of me, but the bonds were issued with an interest rate, all-in interest rate of 3 and change.
2.6%.
2.6%. Since then, the return has been north of 6 or 7%.
Yeah.
So the investment earnings that were earned on the proceeds from the bond far outweigh the interest cost of the debt that was issued.
Yeah. Well, and I wanted to point out, for purposes of people listening in, that the city, during the period, the last 10 years that these bonds have been outstanding, have made payments to beneficiaries, to our retirees, of $300 million.
Yep.
So during that time, so the system is solvent. The question, what we're trying to get to is have it fully funded until the last person is gone, over their remaining life, and we still have a couple people who haven't retired, so that could be another 30 years or so.
Yep. Yep. Okay.
I think does everyone have Andre's?
Do you want me to comment on that?
Yeah. Did you bring copies of this? I thought, okay,
Yes.
so everyone has
Yes.
that. Yeah.
Yeah, so there's a 2-page handout. Looks like sections, little tables from an Excel spreadsheet. And again, just for purposes of those, I haven't been here in a couple of years. My name's Tom Shanley. I'm from John Hancock. As a reminder, in addition to the actuarial services that we provide and that Andre covers on an annual basis, and then also, again, as Brian referenced, was here and met with council a month or so ago, our primary responsibility, in addition to all the actuarial work, is just to ensure that all the members of the pension system continue to receive their payments, that everything is administered, and we handle questions and partner with Morgan Stanley and Greystone from a trust and custody standpoint. So And my responsibility is just on this overall relationship and making sure that our groups continue to do, what we're committed to do. So with that said, if we flip to the second page on this short handout, I can just comment briefly on, I guess we'll take a look at the fiscal year. I know that's an important standpoint. And what this does, the first page, which we skipped by, one sheet lists the fire and police plan on its own, the second, the supplemental, and then this third section combines the two. And then from the top down, there are sections that look at really from the first one is looks back a year, and then it goes quarter activity. Probably not the best way to look at it, trying to explain, but if you look at the top box and the bottom line in that top box, it says June 30, 2021, market value of assets, $254 million, and a funded status at 85.7%. So that's looking back a year. If you go all the way to the very bottom line, on this page, you see market value of assets, $170 million, funded status of 68%. So this is where you can really see the most recent. And if you go quarter by quarter, you can see that the funded status was above 80% until really we hit into this year and the negative impacts of the market. And again, this constant and planned for ongoing distribution of benefit payments. So just during the fiscal year period, just short of $29 million was paid out in benefit payments to retirees. So that obviously offsets about $18 million in contributions which were planned, and then you bring in the impacts of market performance. So again, it's a short term. You see how significantly some down market performance can have on the funded status. Hopefully again, these somewhat recovery trends that Brian talked about continue at least through this quarter, and as we head into your new fiscal year, will help drive some of that funded percent up. But to that point, to Patty's point, just mentioning, right now, roughly around 94% of every individual that is in the retirement system is either retired and expected to begin receiving benefit payments, or they're receiving benefit payments. So as we've talked about for a long time, the vast majority of this liability of the system is already set. There are only a handful of people that still are active that are in this system. And that certainly helps from an ongoing actuarial perspective in the work that Andre does, and again, partnership with Morgan Stanley and Greystone in figuring out the right determination for asset flow.
Tom, do you know the average age of the participant in the system now?
That is in total?
Yeah, or in each individual, the PRS versus fire and police. Do we know that?
I don't have that. All I show is the average age for those that are still active, which is only a handful and is over 60.
Yeah, because I see the trend obviously is liabilities are beginning to decrease from year to year.
Yeah, and we would hopefully expect, and again, I think Andre has shown some of those projections that to occur. That's obviously the plan with the frozen system and so many folks in pay status now. I can get that.
Appreciate it.
Yeah.
I did want to point out, Tom, that to your point, their actuaries, John Hancock's actuaries, calculate the liability that exists for everyone, assuming they live the actuarial tables, whatever their remaining lifespan is. And of June of 21, that was $296 million was the liability. And today, or June 30, 2022, it's $288 million. So that number is constantly updated for who is participating in the system at this point.
And 2 years ago was $306 million.
Yeah, so that's the point I think that Tom was making a few minutes ago, that the liability gets recalculated constantly, and that's compared against the assets, and that helps determine the actuary's recommendation about how much the city should put in each year so that we achieve that at the end day. But the important thing for people listening in is there is almost $200 million in the system, and that their benefits are going to be paid
Right.
on time.
When you say handful, ballpark, how many are you talking about?
Actives,
Yeah.
so there are only 3 actives that are still in the fire and police system. Those individuals have all been with the city for over 25 years. And then there are 11 individuals that are still active in the supplemental system, and all but 1 have also been with the city for 25 plus years. So they're, the expectation is these individuals are most likely going to be retiring and leaving the system pretty soon.
Okay.
So I won't go through just to give you, I know we're up against time.
No, you do cover what you need to.
All right. Well, I'll let you know what's here. It's probably a little difficult to see. We printed it with multiple slides on the page, and Patty, going forward, if you'd like us to connect and also present during these sessions, I'm happy to do that as well.
Okay.
I won't go through all the material. I'll just kind of let you know what is here, and this is with regards to this small handout that has multiple slides on each page. The first section really just looks at the team that is supporting the group. So in addition to myself, Andre, who you've met, and then we have other individuals that handle the ongoing administration, support of communications as questions come into the call center, et cetera. If you skip over to what's defined as page 3 on this handout, and these numbers appear to be a little bit cut off, there's a section in here that just covers data security. And, obviously from our perspective, John Hancock is the overall protection of the data, not only at the city of Portsmouth level, but each of the individuals that are receiving benefits. So I've covered this in the past with the board, but there's information in there on a lot of the services and protection that we do to ensure that retirees' information is protected on an ongoing nature. If there's any ever question or that the board wants to have further discussion on that, happy to do that. Again, I know your primary role is to oversight the investments, but just to give you an understanding of what's going on with the system from an administrative perspective. The next section is, again, common information provided on a quarterly basis that looks at the participant status breakdown, some of which I just mentioned, that can be seen starting on page 7 of this handout. Again, in the fire and police, roughly around 94% of the individuals are retired or terminated with vested benefits, which means they've retired, they just haven't started taking benefit payments. There are 40 of those people, and then there are only 3 that are active, one between the ages of 50 and 59, and the other 2 over the age of 60. From there, we provide just some information on ongoing cash flow, so you just get a sense of the amount of money broken out from a distribution perspective. So, in a typical year, so looking back in the last year, we issued 7,500 payments for the fire and police system for over $21 million. And hopefully, again, continue, knock on wood, all that goes very smoothly as we deal with retirees and ensuring they get these payments. There is a new slide I put in here, and we'll update this on a quarterly basis. It can be seen on page 8, that this green heading, I know again it's difficult to look here, but what it does is just looks at activity during the quarter for participants. So 2 sections on here, new periodic distributions. So essentially how many people of those terminated vested have begun taking benefit payments, or if an individual passed away and had a spousal set up for ongoing payments, how many of those situations occurred. So during the quarter, there were 7 of those situations with 2 individuals just starting to receive payments. And then there were 4 situations of benefits ending. Typically, you're going to see that because unfortunately the individual passed away. If you look at it from the perspective of the power of what this program has done, 2 of those individuals received payments from the system for over 30 years. So that's obviously the kind of long-term benefit that the city has set up with this program. And then we do the same for the next few pages, look at the supplemental system. Again, only 11 individuals are still actively employed that are in this system. 330 are receiving payments, and 10 are expected to start receiving payments in the near future. And then similar information, again, from a cash flow perspective, showing contributions coming in and benefit payments going out. So again, over 4,000 for this system in payments made during the year for over $7 million. And then if we look at just quarterly activity, there was only one new periodic distribution change. That was a start of a spousal benefit, and there were 4 deceased members from this plan during the quarter. But again, years receiving benefits, 31, 21, 14, and 9. So the program supported benefit payments for decades for some of these individuals. And then the last section, and this information can be seen on what I believe is page 11 here. And again, it's going to be very difficult to see, but as you know, we disclose expenses on an ongoing basis and update this information quarterly. If you look at it on overall investment management expense, so what all the different investment managers are charging to run those specific positions, roughly around 36 basis points on an annualized basis. Then we have Greystone's fees of 10 basis points, our fees of roughly 6.5 to 6.7 basis points, which total all-in expense for the system of about 52.5 basis points on an ongoing basis.
Now, does this include, you mentioned the fees that the funds pay? Are those the funds that Greystone manages?
Correct.
Okay, so it's not
That's everything.
double pay, okay.
No. And at this point, really, with the exception of that Artisan fund, which we hold at John Hancock, it's a pure mutual fund holding, Morgan Stanley's holding the assets and managing all the assets for the program. We have a process in place where cash comes over to us on a monthly basis to allow us to then pay out benefit payments.
So you're record keeper for all of it, but only custodian for that one piece?
Yeah.
And how much is a basis point, and how often are basis points received?
Yeah, so I mean, fees are deducted daily from an investment management standpoint. There are 100 basis points in a percent. So if you look at it, it's 0.35 of a percent. So less fees all in would be 0.5%.
Correct. And that's an annual fee, even though fees are deducted on a,
Yeah.
A pro rata daily, yeah.
yeah.
So
I think that's
yeah.
important to point out, because I think there's some confusion on that it's paid out quarterly or whatever, but it's
Daily.
an annual, it's
It's
paid out daily, but it totals in a year.
Right.
That .52. So
Yeah.
it's not multiplied by some other number. It's what these numbers are.
Understand?
Right. And then our fees, like for what we do, we invoice quarterly, Greystone invoices quarterly, but the bulk of the ongoing fee is that daily factor.
Okay, yeah.
And Greystone's quarterly fee?
It's 0.1%.
That's the annual fee. So
Annualized.
quarterly would be 0.025%.
And
We are 0.065, so roughly
Less than a
percent, yeah.
I
A little
think
bit more than.
Yeah, just to clarify, financial people use the word basis points all the time.
Yeah.
So it's a basis point is 1/10 of a percent.
100th.
1/100, excuse me.
Yeah.
1/10 of 1/10.
And just a little bit of context on the fees. There's a pretty meaningful difference between sort of institutional fees for investment management versus retail. If you were to go buy a mutual fund on a retail, like a regular person,
Yeah.
you'd be paying much higher fees than what we get with institutional investments. Generally speaking, the more money you have to invest, the lower you can get the fees. With the $200 million that we have, in my experience, the roughly 45 basis points that we're paying is pretty competitive and sort of in line with what you would expect based on the amount of money that we have.
Yeah, Landon, I would say there's public fund surveys out there that look at fees, and the average public fund is paying right around 44, 45 basis points. So, and that's just for investment management. We're at 36, so there's obviously a lot of other public plans that are bigger than the 200 million. Not to say that 200 million is a small portfolio by any stretch, but the fees, we've aggressively negotiated those investment management fees.
Well, the essence of what I'm trying to do for my sake is to put it in standard mathematical terms, and that's all I'm trying to do.
Good question.
Yep. So in this...
No, I'll do it.
No, I'm just saying in the chart, it does tell you the dollar amount
Yeah.
also.
And I can tell you that for my personal investments, which is probably half of what you got, but I'm paying a lot more than this rate on terms of my fund fees.
Oh, okay.
Yeah, I just wanted to point that out, which is what they're saying. We're small investors compared to this large plan.
Right.
And Patty, I believe all of this information was emailed out?
Yes, and it is been emailed to everyone.
Yeah, okay.
So if
Because
you
again, I
wanna
know
go-
it's hard to see.
Yeah, well, it's attached to the meeting notice,
Right.
so you have it, so you can always go back to your Outlook calendar and look at it and admire it.
So that's up. Okay.
Does that conclude your
Yes.
comments? Thank you. Anybody else have questions or comments before we adjourn?
I tried to put the briefing to City Council from June 28th in your package, and it certainly is attached to your meeting notice. So just wanted you all to have it. Some of you already had it, but
And actually, I do have a question. So typically, and I know this changed a little bit through the pandemic years, typically the annual actuarial review would be presented in October, which is a little bit off cycle from how these quarterly meetings work. We may have waited last year and done it at the November meeting. I wanted to see if there'd been discussion about that.
we did wait to November. Of course, we want it because we need to put it into the audited
Right.
financial statements, but
You think the November session is fine for the board update, or do you?
I think it is.
Okay, perfect. Well,
Because it's the rates that we're going to use in fiscal,
right, Andre will still provide, as you said, the material
Yeah, right.
on schedule, and we can plan on November for that overview. Okay.
because they'll use it for working on the budget for '24, which they will be starting on real soon.
Okay.
All right. Meeting adjourned.
Thank you. Next meeting is November.